Brett Holland. I'm with Stifel Financial, Mike Battistelli, business partner with Stifel. Sonia Gross, also with Stifel. And we have Jason, who's here today with Jeff Davidak, representing CS McKee, which obviously they represent or manage a large portion of the assets for the county. So thank you for allowing us to come in, and just want to kind of go through our report, and then Jeff's going to make some comments on kind of insight and things that they're seeing looking forward. So if you turn to page 1, like we typically do, and the page is again kind of split up in kind of 4 sections. The top left section there, underneath those bar charts, is combined portfolio, which just represents the pension, and shows the quarter, and this is ending the end of the year. Mike has up-to-date numbers, which I'll tell you right now look a lot better. So, but ending the quarter for last year, this is ending 12/31. Fourth quarter of 2018 was down 8.32%. A year-to-date number was down 4.01%, which obviously that's for the full 12 months, so the one-year number says the same thing, January 1st through December 31st of the 4.01 negative. 3-year number is positive 4.99, and then just the inception number is the 5.27. I want to take just a moment, I don't want to take a lot of time away from Jeff, but I want to make a comment about if you see the benchmarks listed underneath there. If you turn to page 11, this is kind of where some of the benchmarks are listed back here. We don't talk a lot about benchmarks. I don't want to say they're irrelevant, because they certainly have an element of relevance, but benchmarks are kind of fixed. And in the back page 11 on the right side, if you see there, it says benchmark description, and underneath there it kind of represents the pension. And this is really quite different than what your managers, where the managers are invested right now. It shows the S&P 500 at 50%, which is the S&P 500 is the largest 500 companies in America. Barclays Ag, which aggregate bond, which is your fixed income of 35%. The REIT portion of 5%. Citigroup 1-month T-bill, which would be kind of like cash, of 5%. And then mid-cap growth or medium-sized companies of 5%. And part of the reason why I point this out, just because on that page 1, we're not comparing apples to apples. I would say it's barely apples to oranges, quite frankly. Because in the back, on this page 11 here, in large company stocks, it's more like 35 to 40% that the county has invested in large company stocks now. Medium-sized company stocks are 8%, and in here the benchmark is at 5%. Small company stocks, the pension is at 6%, and there's none of that represented in the benchmark at all. So we're not, again, comparing apples to apples, so I just want to caution you as you look through that. Underneath that combined portfolio benchmark, you see the 4X's and then 7132 benchmark. And that's actually where the ARC payment goes into. So I think the ARC payment this past year was just a little bit less than $3 million, which is just cash. We hold that in a money market, an FDIC-insured money market. And that's being compared to 60% in stocks and 40% in bonds. So obviously a money market's not going to keep up with a portfolio that has 60% in stocks and 40% in bonds. So I just wanted to mention that as you see that on the first page there with the benchmark listed underneath it. Any questions on that at all? I kind of went through that rather quickly, but any questions on that?
I have one. Go ahead. Mine's, the REIT is an alternative.
Yeah.
Do you see in your world that expanding to 5% more alternative investments as a way of balancing a portfolio, or are we too conservative in what we do here for that?
Well, we've taken it up to as high as about 9, I think.
8 or 9%.
Yeah, we've taken it up to that point. And actually, even from an alternative standpoint, the S&P 500 about 2 or 3 years ago started including REITs in it. So it is different than a traditional stock or bond, but it's probably not as alternative as maybe it was at one time. So
Maybe to further that, there are some other alternative strategies out there, and we hear a lot of other pension plans are utilizing that, but we haven't seen that there's been enough value added. That's kind of like the focus word, alternatives. You want to have alternatives in your pension, but we just haven't seen enough evidence that it's really added value.
But when you see like Yale and Harvard at 90%, probably alternatives and other private. I just didn't know if that was a trend that would be, used by governmental pensions. I guess it's a little riskier, so you wouldn't want to go there.
We think there could be more volatility in that type of strategy, potentially. There are some alternatives that maybe not so much, but
More volatility
we've always
equities.
tried to manage the risk and mitigate risk in this portfolio.
All right,
for you.
Jane.
I guess I think I know what you mean by when you stated that the benchmark is fixed. I think what you mean is that the makeup or the menu of benchmarks that make up Stifel's benchmark isn't exactly reflective of what our mix is. So do you have the ability to customize that benchmark at all so that it is closer to what the investment policy of the board is?
We can. That changes from quarter to quarter, well, actually almost month to month, but we could get it closer, so that it'd be a little bit more accurate than what it is right now.
So I don't know if that was something that Stifel just provides without your input, or if it's something where you can say, hey, can we tweak this to 45% instead of 50 or 35?
I think we could. The hard part is the overall allocation of the pension itself. Feel free to jump in, Mike, too, if you have something to share with us too. But the overall allocation, over the years, if we go back 10 years ago, during 2008, we had around might have been a hair less than 50% actually in equities. So it's almost like the benchmark is fixed, and the pension itself is moving at different times. But we could obviously adjust it and try to get it closer.
If you have the ability, before this is generated, to move any of those, or if that's something that Stifel just says, these are the benchmarks we're going to use.
No, we can make that change, but again, I think what point Brett was trying to point out is that, 3 years ago, if we did that, if we updated it for this past quarter, where we were invested 3 years ago, and you look at a 3-year annualized number,
Yeah.
may not be a great
Yeah, it would only be
comparison.
helpful for the quarter, really.
Exactly.
Okay.
Just one comment at this point, is that 4.01 currently going around the Controllers Association is the annual returns from other counties. 4.01 of the 12 that have responded is the second lowest as far as at least everybody's in 5s and 6s. Negative.
Negative.
So everybody's much more conservative than most.
Any other questions at all on any of that? Okay. Going to move over to the right side there where the line chart is there, just showing under the quarter the beginning balance of $126,955,002 was the beginning. Again, that would be starting in October 1st, and then with withdrawals of 2.1 million, and then depreciation during that quarter of 10.5 million. Had an ending value at the end of December of $114,319,485. To the right of that just shows the year numbers, again, starting out at 125 million, and then having withdrawals of 5.9 million, and then depreciation of 4.7 million, again, ending the year at 114 million there with those. And then the bottom left side just kind of shows, again, our allocation. Equities are listed at 65.22. Again, we always just mention that REITs, to your point, Commissioner Phillips, those are part of that. They're kind of mixed in there, and that REIT portion is 5.51%, where your equities are actually 59.71% is what they truly represent there. Fixed income of 31.39, and cash is at 3.39. And the last thing I'll just mention is, without getting into it today, again, with having Jeff with us, the big thing that we talk about over and over and over and over is risk management. How much risk are we taking on to get the reward that we're getting? And those numbers, again, kind of ebb and flow. Those numbers have moved in a very positive direction this past year. Although we had a negative year, the amount of risk that we're getting for kind of the protection that the portfolio has had has been a positive thing. And I think that's probably the overriding most important thing is, you folks would have as fiduciaries of the plan. So any other questions with any of that? Okay, I think Mike's gonna give a more up-to-date number.
These numbers will look a little bit better, so Brett gave me the easy job today. So year-to-date, and this is through yesterday, the portfolio for the year is up 8.74%. with a balance of $123,206,759. So we've gotten a good bit of back what we had lost in the fourth quarter. A couple things to point out. Last time we were in, we brought in a new manager, replaced a manager. So Dearborn Partners was that new manager that came in. They are actually up 10.8%, so that's been a positive change. The other manager that we had replaced in the fall, Capital Group, they're up 10.5% as well. So just a little feedback on the most recent changes that were made. Allocation-wise, pretty much the same as the year end, so we won't go into those. And I think that's pretty much it, unless there's anything else specifically, more up-to-date numbers you needed.
So Dearborn, they're off to a good start.
They're off to a good start.
I'm very thankful that the numbers are creeping back up.
Right, yeah. Yeah.
It's a little scary.
Fourth quarter was very challenging, especially December. I'm sure Jeff's going to mention that. There's a number of reasons why, so.
I'm glad we didn't borrow money to put in there then.
Right.
Yeah.
Right. So at this time, we'll turn it over to Jeff and CS McKee to give you an update on their portfolios and the markets a little bit.
Thank you very much, and appreciate very much on behalf of everyone at CS McKee the opportunity to meet with you and to work with the county. As Mike had mentioned, and as you're all undoubtedly aware, there was a huge spike up in volatility in the markets in the fourth quarter, particularly in December. December of 2018 was the worst December for U.S. equities since 1931. And for anybody that's big into statistics, it's close to what we would call a third standard deviation event. It's just very uncommon to have that much of a move. And the key theme that has really been weighing on the equity markets in our view is this ongoing negotiation between the United States and China with respect to trade. It's intuitive if you think about all of the billions of dollars that both countries have invested on each side of the Pacific. Many of them have borrowed money to make long-term commitments to factories and production, trade relationships. And so anything that would upset the framework in which those investment decisions were made has the potential to impact analyst forecasts for what these companies will earn in 2019, 20, and beyond. There are two main schools of thought about China trade in the market today. One is that this is a temporary phenomenon that will lead to a negotiation of some improved trading relationship, preferably in favor of the United States. And the second is that this is going to escalate, and it's going to become a prolonged, maybe even perpetual trade conflict between these two important global economies. How you structure your portfolio depends on which school of thought you adhere to. At CS McKee, we're of the belief in how we manage equities for the county that this is not going to be a permanent state of affairs. We are cautiously optimistic. Yes, tariffs have been imposed, but there's also been a sort of détente where we've had this 90-day window, and then Trump and Xi are going to revisit trade talks again in the very near future. We believe that there's too much common ground for this to really escalate to the point where U.S. stops doing business with China, China stops doing business with the U.S. It still has the power to impact through headline risk what the markets do in the short term. But over the long run, we can see the benefit that's happened with that détente even over the last 2 months. It's been a very strong start to the year, and I'll give you an update on the CS McKee portion of the county fund. If you take a look at the first tab of the CS McKee report, you can see that it was a very difficult fourth quarter indeed. The large cap value portfolio that we managed for the county was down 14.34% versus a Russell 1000 value benchmark of 11.72. The account in large value had been well ahead of the benchmark through the first 3 quarters of the year and gave it back in the fourth quarter. Year-to-date 2018 for the 12-month period, large cap value was down 9.2% versus negative 8.27 for the Russell 1000 value, and it's ahead on the 2-year period. What we've built is essentially a pro-cyclical portfolio. As interest rates rise, as the economy strengthens, as we move into more traditional financial conditions, the overweight in the portfolio to sectors like technology and industrial should outperform. In the fourth quarter, it was the most defensive sectors of the market. Your utility companies, with the exception of the Pacific Gas and Electric that was impacted by the wildfires in California. But those utility companies that pay high dividends, your big pharmas that pay high dividends, your bond substitute type stocks did very well in the fourth quarter. And we were underweight those companies mainly because in a world where we're trying to find ways to meet actuarial targets for funds, we feel compelled to invest in companies that have earnings growth rates above those actuarial targets. We wouldn't invest in a company like Merck if Merck's 5-year growth forecast for earnings is 5% and the county expects to earn 7% on its plan. To us, that doesn't seem like as appropriate of a fit in the context of the fund. That being said, with the improvement in market sentiment so far in the year, the value of the plan has increased. The assets with McKee have increased from $47,731,896 at the end of 2018 to $48,788,090 as of yesterday's close. Year to date, the large cap value portfolio that had a rough fourth quarter is well ahead of the Russell 1000 benchmark. The Russell 1000 year to date through February 20th is up 11.46%. The county's large cap value portfolio is up 12.82%, so 136 basis points ahead. And over the 3-year period and the 5-year period, the county's large cap portfolio is ahead of those benchmarks, as well, because we have moved with improving unemployment, strong GDP, into a growthier kind of environment that has benefited these pro-cyclical types of stocks. Real GDP year over year is plus 3%. Nominal was 5.5%. Unemployment is at 3.9%. So these are all the ingredients that you would want to benefit growth types of stocks. The bond portfolio continues to face the challenge of very low rates, but there are positive returns. And over the last year, the county's bond portfolio with CS McKee was up 91 basis points versus a benchmark of 92 basis points. Again, we are of the opinion that interest rates should normalize. And the expectation that we have is that the Fed is going to pause in caution about what will ultimately transpire with the China negotiations. The Fed funds range is currently 2.25% to 2.5%. The Fed Chairman Powell made a statement in December. He was pressured by the administration not to raise rates. The Fed has famously, throughout its history, voiced its independence from the rest of Washington. So even though Powell privately may have wished to keep rates in neutral, he felt compelled to defend the Fed's independence and honor, if you will, and they raised rates at the December meeting. Now in 2019, the language has changed to one of more caution. I think our sentiment at McKee is that's to build a buffer around these China negotiations in the event that the market should hit a stumbling block. I'm happy to answer any questions that you might have about the McKee portfolio. One of the things that my colleague Jason Petner has brought with us today is a chart of the quarter. This is from CS McKee's Education and Information Portal. And what this is showing you, there are 3 data sets that we've looked at. The data has come from the Fed. And we define the 3 main sets of financial conditions as loosening, flat, and tightening. And the analogy that we use in this piece, it has to do with predicting tomorrow's weather with today's information. I feel for everybody that was affected by the horrific snow and mix that shut down much of this area yesterday. We might have used that as our analogy instead. But the way that I think about this portfolio, the way that we philosophically want to manage money for the county, it's like having snow tires or a 4x4. You're probably not going to get as great of fuel economy when conditions are sunny. But when conditions get bad, you're going to have more stability and security in those extremely volatile markets. What you can see is relevant to Commissioner Phillips' comment earlier about alternatives. We're showing the performance of most of the major asset classes that a pension fund could invest in across these different conditions. In the loosening financial conditions data set, the only negative performer is the VIX, the volatility index. If you bet on volatility in an extremely calm market with accommodative monetary policy, you'd be a disappointed investor because there's hardly any volatility when the Fed cuts rates to the floor and you're trying to stimulate the economy. And that's what we've seen in this bull market over the last decade. But as you move into flattening conditions and think about rates starting to normalize, the Fed easing back, volatility starts to pick up in the market, and it becomes more of a challenge for funds to manage in their allocation mix. The asset classes that do best in loose conditions, areas like real estate, which averages a 17.25% return a year in loose conditions, start to become weaker performers, dropping to 3% annualized when you have flat conditions and negative 25% when you have tightening conditions. And that makes sense if you think about all the mortgages that companies have to take out, whether it's on commercial property or apartment complexes, those sorts of things that would be in a REIT. If their borrowing costs go up, it puts pressure on their earnings. We're of the view that as we move from this extraordinary period of loose conditions with extremely low rates and quantitative easing into a more normalized kind of market, the county's overall approach to try to mitigate some of that volatility risk, it should be of benefit in smoothing out some of the peaks and valleys of the market volatility that we've seen. But again, I'm happy to take any questions that you might have. But
you may have mentioned it in a way that I wasn't catching it, but inflation, what do you see?
For inflation, the 10-year break-even inflation is about 2.5%. We are, along with many of the folks in our industry, we're hoping for a healthy level of inflation. If you think back to deflation concerns when oil was in the 20s, $20 a barrel range, we don't want to see deflationary conditions. The Fed's challenge has always been trying to time their policy just right. You don't want the economy to get too hot where you have hyperinflation. You don't want to put the brakes on a growing economy and cause a deflationary spiral either. We think that in its actions, the Fed has shown a preference to erring on the side of maybe a little bit more inflation than would be ideal, but they don't want to send economic growth back the other way. In the bond portfolio, we've tried to build in a little bit of inflation-protected securities as part of the position. The focus is still on shorter duration. As the Fed raises rates, shorter bond portfolios have been outperforming longer-term bond portfolios. And you may recall a couple years back, this board authorized our recommendation to shorten the bond portfolio for the county. That's been a good decision. That's paid out very well over the last 2 years as rates have increased. So we would expect to be a little bit shorter duration, maintain a bit of an inflation hedge, and then as we get to a more normalized level of rates, we can start looking at lengthening the county's bond portfolio again and locking in some of those higher yields.
Barring a crisis nationally or internationally, do you think we'll hit our benchmark this year?
We're off to a fantastic start. As Mike had stated, it sounds like you guys are already maybe above your target for the year. You know, those GDP growth numbers are significant. Traditionally, for every 1% GDP growth that the economy produces, you get about a 4% pickup in earnings growth for corporations. So if we end up with a 3% year for GDP, you're looking at 12% earnings growth. If multiples are reasonable for the market, which we think they are, the average price to earnings ratio for the county's large value portfolio with CS McKee for 2019 is 11.7 times earnings. That's not an overvalued market. If earnings come in at a pretty good clip, you should see some reasonable equity growth. Bonds we don't think are going to help a whole lot towards your target, but maturities, the yields to maturity are starting to creep up. The average yield for the county's bond portfolio with CS McKee has increased to 3.45%, with an effective duration of just over 4 years. So,
What would you, with only 60% in the equity side, what would you have to hit in order to get to 7.2 or whatever overall?
There's a great study that I know Brett and Mike have been looking at. There's an actuarial forecast that's done by an entity called Horizon, and they assign probabilities for pension funds to hit those actuarial targets based on the forecast for individual asset classes that might make up a portfolio. Working with funds all over the country and being on the board of papers and you know, really kind of being knee deep in this pension stuff, 7% is a pretty realistic target. I worry for plans that have targets, some of them still at 8%, some of them at 7.5%. The challenge is that those models, those assumptions were built on bonds chugging along at 5–6% a year. Back in the 80s, you could have conceivably put your entire fund in bank CDs and exceeded your actuarial target. That's not available to you as trustees. You're playing with a different hand than your predecessors from the 80s or the 90s, even the early 2000s. And so it's become challenging for funds to have to accept more volatility to get to the same place. We're hoping that rates on bonds will come up before this equity market gets to the end of its cycle. That would be the Goldilocks scenario. Right now, bond returns are still not on that order of magnitude. So we feel that the heavy lifting in the fund really needs to be done by your risk assets. And we should try to maintain a high level of liquidity, downside protection in the bond fund. But you know, to your point, 7 is a reasonable target. Most actuaries, I think, will tell you, to a man or a woman, if you have the ability to take your target down lower, they're all for it.
But then we couldn't afford the ARC either.
Right, right. The 10-year forecasts are more pessimistic than the 20-year. Most of the models show interest rates rising, bond yields rising to a normalized level in the 20-year window, but the 10-year window is going to be really tough. And you know, to the point about the Harvard and Yale model, one of the things they've tried to do, they have the benefit of running less liquid portfolios. They don't have to make the level of disbursements that most public funds have to make. They can let that money be locked up for longer periods of time, and they can get that illiquidity premium. So that's how they're trying to respond to it. But for public funds, especially with mature demographics, if you're at parity with your number of retirees drawing out versus actives putting in, if you're not in a growth area like Butler County where you have a lot of young public employees contributing to offset the outflows from the retirees, that need to maintain liquidity, you know, can be a big challenge too. And it's another reason to think about having your funds target lower. I give this board great credit for being at a 7% target well before many of your peers, because I think that you have built in a higher level of fiscal discipline to the county in doing that. You don't want to have unrealistic assumptions for your plan. That's how General Motors got into trouble. GM Corporate didn't want to pay the recommended contribution into the pension fund because it would have hurt the earnings that they would present to their shareholders. So they said, we'll assume the investments do better. We're going to use a 9% target. GE did the same thing. And in reality, they earned 6% or something lower, and they built an unfunded liability over time. And then their ARCs or their MMOs, the ADCs, they really went up a lot. So by getting your county to a place where you have a realistic target of 7%, you've at least given yourself a pretty good framework to keeping this plan sustainable without having to take excessive levels of risk. A lot of those plans that have kept the high targets, investment consultants and advisors can build any kind of portfolio that you as trustees want. But ultimately, the philosophical choice is up to you. Do you want to accept more risk in your plan because it's just fiscally not possible to reduce those assumptions? Or are you going to take the fiscal hit now to try to prevent that funding gap from happening later? And I think all of you at this county have set a framework that is wholly within reason and sustainable for the fund.
And I think the assumption that we will continue to fund the ARC, I don't think it's a question of can we afford it or not. We're committed to doing that. So that's another piece of the equation that isn't always, adhered to. Okay. Well, thank you.
And thanks for putting it into terms that people can understand between the bond CDs at the local bank. People can remember those days, and it makes it easier to understand somebody just listening in.
I appreciate that very much. And just as a final note, if you'd indulge me, I wanted to let you know that my colleague Jason has been working on a project with Penn State, our state treasurer, the AIU. And if you haven't received notification about this already, and this has nothing to do with us at McKee, the state is offering free financial literacy programming to all school districts in the Commonwealth through the AIU. So if you have any school districts here in the county that would be interested in having access to online lesson plans or course materials for promoting financial literacy education, that's something that we'd encourage you to check out just as a new resource that's available.
And this is for students?
It's for students. There are 130 school districts approximately that have enrolled in this program over the last year or two. And we're excited about anything that encourages a culture of saving and fiscal discipline.
How long is the course? Is it a one semester or is it a year long?
Teachers can customize how they structure the program, which is one of the nice things about it. It's not intended as a replacement for any existing seminars or programming they do on financial literacy. The state's very passionate about addressing proactively the challenges of student loans and credit card debt and some of the obstacles to saving that young people encounter. But we anticipate all of you hearing more about this through CCAP and the Controllers Association and the like. And I just wanted to make sure that you're aware it's available to the schools in Lebanon County.
Thank you.
Before you leave, Bob, did you have anything?
No.
You good?